Support. Well, support is actually the level where buying pressure overpowers selling pressure, preventing any further price fall. Think of it like a floor, as we said. A support zone is the perfect place to be looking for opportunities to buy the market. What is resistance? Well, it's the level where selling pressure overpowers buying pressure. Okay, so it's exactly the opposite. This is where it prevents any further price rise. It's a ceiling above the price. A resistance zone is the perfect place to be looking for opportunities to sell in the market. So it doesn't necessarily mean it's only horizontal, because that's one type of resistance. Also, for example, when the market is trending lower, these are going to be resistance points. Okay, diagonal. So you have basically what we call horizontal support and resistance, and diagonal support and resistance. Okay, so when the market is trending, you have diagonal, and when the market's going sideways, you have horizontal. So make sure you write that down, guys. So what you want to do is the following. Open up your chart, identify the swing highs and the swing lows on the chart like this, and then start to draw your support and resistance levels. Draw a horizontal line at the high or low of these swings, and the idea is to find past areas of support and resistance that have held in the past. You can adjust your line between the high and low and the body of the candle to find the perfect line. In other words, it's okay to go through the wicks here. Okay, we call these wicks, but don't go through the body. Candle wicks are seen as areas of rejection, so at this level the market is likely to hold again. The more rejection we've had at the same level, the more important the level. So here's an example of what this looks like. So you can see over here, notice how this is an area where the market held, and it held again right here, and it held again right here. And then eventually notice how the market breaks this area here, and then look how it ends up coming where it was resistance and now becomes support, and support again, and support again. So notice how that market holds there really, really nicely. So as soon as you break through this ceiling, it then becomes a floor. Okay, so past resistance becomes future support. So what is a trend? Well, in the Forex market, the trend is generally the direction of the prices. The trend can be classified in one of three ways. You've got an uptrend, a downtrend, or no trend. Okay, also known as consolidation or range bound market. What are trend lines? Well, a trend line is a line drawn on a price chart to help a trader identify the trend. It's formed by drawing a diagonal line between two or more price pivot points on a chart. The third touch is a potential trade in the direction of the trend, and it's actually the confirmation of the trend. A tip is look for the closing price rather than the spikes when assessing whether the trend line has been held as support or resistance. This is important because sometimes, it isn't clear and people draw different types of trend lines. What we teach is for you to draw the very same trend lines every single time, just consistently. But if you use the closing prices rather than the wicks, it will tell you when a trend line has been broken. So generally, here's some tips. 2 points can be connected to draw a line, but you need a third touch to confirm the validity of a trend line. The more touches you have, the more relevant that trend line. You also want to learn to study the steepness of the trend line. Okay, so if you've got a really, really steep trend line, the market is then moving very, very fast, but unfortunately the probability is that it won't last for very long. So you can use it for short-term gains, but the probability is that eventually it will break and go back to a more sort of normal trend line. So what is a break? Well, an impulsive close 50% of the candle above a trend line that the market has not closed above before. That's what I would class as a break. So here's an example. Notice how this is a supporting line, and it's what we call a counter trend line. Breaks and closes below this line, and it is 50% below that line of that candle. So therefore that would class for me as a break and an area that we could be looking to actually sell this market there. So how do you draw trend lines? Well, to draw lines, you must firstly identify the market direction. You do this by identifying the highs and the lows. In an uptrend, you must connect the lows. So here's an example. The market, you can see we've connected these lows here. Okay, and eventually notice how the market breaks and then goes back and retests these highs, and then eventually the market goes lower. In a downtrend, you must connect the highs. So again, very similar. So notice how the market is in a nice downtrend, connecting these highs. So we've got one touch, second touch, here's the third, and that's where you'd be looking to sell. Eventually the market creates a nice inverse head and shoulders pattern, and the market breaks back up higher. So here's an example of what it looks like when you're connecting the trend line. You can see where it's highlighted here, points where the market basically acts as a support area. So this is what we call a support zone, support zone, support zone. So these are areas where we're basically looking for buying opportunities. Okay, so nice trend line. Continued. Here's the third touch, the fourth touch, the fifth touch, the sixth. Okay, this is near the zone. It doesn't quite touch there, but again, you're still looking at this as a zone to be looking to buy. You can see actually there, this is a nice actual morning star formation, which is a great setup there as well. Okay, so lots and lots of opportunities there, and if you just simply played counter trend line breaks, you know, you'd be well in the money just trading these. Once you've picked the direction, it's very easy to, you know, you could also play breakouts, for example, there of resistance. So that concludes trend lines. Next, we're going to move on to Fibonacci, how you can actually use Fibonacci to aid you in terms of target and entry points. Okay, so in this section we're going to look at Fibonacci and how you can actually use this to actually plan your trade entries and your trade targets. So let's begin, guys. So here's an overview of how this works. So the Fibonacci rules are simple and repeatable. So what we define as a swing high are 2 candles to the left and 2 candles to the right that are lower than the highest point. Also, a swing low is the lowest candle which has 2 candles to the left and 2 to the right that are lower than that are higher than the lowest point. So I will show you what that looks like visually. So if you have a look here, this point here, let me just show you, let's get the pen out, is the highest point, and these two are lower than this high, and that's what we call a swing high. And this low here is what we call swing low, because these two are higher than that low. Essentially, the way Fibonacci works is that the market moves in waves like this, and it moves in Fibonacci ratios. This is something that we cover in a lot of detail in the applied trading program. So these are pullbacks that are fixed within Fibonacci levels, and these targets are, again, as you saw with the previous examples, very accurate to actually show you where the market's going to go and then pull back. Okay, and I'm going to show you some examples. Here's how it all works. So the market moves in Fibonacci waves in all time frames. Very important to understand. So in other words, it's moving like this in all time frames. Even when you get periods where the market's going sideways, it eventually gets to its Fibonacci targets. Okay, so you just got to understand where you are in the market and use multiple time frames to help guide you. At London Trading, we utilize dynamic Fibonacci waves. Okay, you want to think and learn of each wave as one game. In other words, what we want to do is we want to trade this kind of game here, which is a C to D game. Okay, and that's what we're going to cover in the strategy section. So in other words, when we're trading with the trend, we're just looking at this being one game. Our job is to actually capture this bit here or this bit here. Okay, and that's what we're looking to do. So each time we capture it, then you get out, and that's the game complete. Okay, so think of each wave as one game. For a downtrend, the game begins with the highest point on your chart, where you move down from the high, your A point, to the next low point, your B, and that creates your first down AB boundary. So I'll show you what that looks like visually, but it will basically be something like this: A, B, C, D. For an uptrend, the game begins with the lowest point on the chart, where you move up from the low point, your A, to the next high point, your B, and that creates your first AB boundary. The market then retraces to a Fibonacci level known as your C and extends to your D to complete its wave. Once the wave completes, the old C to D becomes the new A to B, and the game begins. So it's a very dynamic way of doing your Fibonacci's. And to illustrate this, this is what it looks like. Okay, so B to C is what we call a retracement. Okay, it's the pullback, and C to D is the extension. So this is where, you know, if you want to trade with the trend, you're going to be looking to trade C to D extensions, and if you're happy to trade against the trend, then you could be looking for these retracements. For a downtrend, again, this is the retracement. So the market is basically moving down, but it's retracing that down move here. In other words, it's going up, and it's called the B to C retracement. And then when the market resumes its downtrend, it's called the C to D extension. Once again, if you want to trade with the trend, you'll be looking to trade this move down. So in terms of ratios, what we look for is for pullbacks basically to match extension levels. These are some of the Fibonacci ratios that we use. Okay, so it varies from the 38.2 to the 618, and this is what we call our red zone. Okay, here. And if it gets to our red zone, we simply just target this red zone down here, which is our 1618. If the market pulls back deeper, up to a 78.6, then we are looking for the 127. This one is a little bit more rare, but I'm going to write it in anyway. It's a 118 here. Okay, so if the market pulls back, sorry, ignore that. If the market pulls back to an 86%, then we only expect the market to get down to its 118 extension. And what these ratios basically mean is that you take this move here, A to B, to be 100%, and then we take 61.8 and add it, and that gives you the 1618. 27.2% gives you the 127. If you add 27.2% of that distance from A to B down here, and then 18% for the 118. And all of these are Fibonacci levels and ratios, and they work very, very well in the Forex market. Let's show you some examples of this, okay, how it looks. So here is an example of your A to B to C to D movements. Okay, and I'm going to just start with the first one. The first one, when the market tends to reverse, so this was a downtrend. Obviously you can't see the rest of this chart, but when the market reverses its downtrend, it tends to overshoot beyond its 1618 target. So you can see this was the initial target, and it actually went and created a high point all the way back up there. So once that was complete, then we had a new A to B. Here was our C pullback right here. So in other words, it was within the red zone, and you can see that means our target was up here in the red zone, and that was a perfect hit, and the market pulls back. So you notice how, we went slightly above this area here, but eventually the market came back down, creating a new AB. So this becomes our A, here's our B, here's our C here. So here's an A, B, C, and look at this, perfect hit. Again, here's our D target up in the red zone, pullback was in the red zone, and again a perfect hit, and the market comes off. Okay, and these are not just examples that I've just handpicked and very rarely happen. These happen all the time, guys, in the markets, and that's what's amazing about this strategy. So what do you think would happen if you could combine all the above technical tools? If you could get the market at resistance on the third touch of a trend line, 50% retracement on a Fibonacci, a shooting star formation, it then proceeds to break a counter trend line. If you took that trade 10 times, would you feel confident that you would make money with the risk reward in mind as well? Now that's what we're talking about when we say about high probability trades. You're looking for opportunities for when things align. Now you could just trade the Fibonacci, you could just trade candle formations, you could just trade counter trend lines, you could just trade any of them individually. But if you combine the lot together, imagine the power and the probability of that trade working is very, very high. So that's what we believe. You know, if you add the risk reward to these trades, it adds even more reason to take the trades. In other words, if you're going to make more than what you risk, it adds even more to the trade. And that's what we're looking for. We want you to build these high probability setups. Okay, so let's have a look at an example now. So here's an example of what we're talking about. So here's a Fibonacci indicator that's been drawn in for us. So here's our A, okay. This bit up here is our B, and here is our C. Okay, pulls back to the 50% Fibonacci retracement. Here's our 50%, the red zone. Here's our target. We'll have a look at this. Bouncing off a trend line, nice support, nice rejection candle. Then we break. Look at our breakout candle there. Counter trend line break, 50% Fibonacci in an uptrend. Here's our target. We buy it there. We target there. I would basically place my stop below this trend line, at least there, or below this low test bar here. And look how perfect it gets to our target, and then eventually pulls back. So you're literally waiting for all these things to line up for a high probability setup there. Okay, and that's what you really want to do. You want to find these high probability setups before you take